And many of you will be here to hear from our next speaker, who's Lucian Cook, who's head of research at Savills, a familiar face to those of us in the industry and a regular speaker at HBF events. So we're very keen to hear from Lucian about his thoughts on what's been going on during the pandemic, and also as a forecaster for the housing market, where he sees things going next. So over to you, Lucian.
Okay, thank you, Neil. So as those of you who've heard me speak before know, I choose my images very carefully. I think last time I presented to the HBF, I had a picture of an automated Australian bricklaying machine, which at the time I suggested was the future of modern methods of construction. This time round, I've gone to the other end of the scale, and I've gone for the early inception of modern methods of construction, and just a demonstration of what can go wrong if you don't follow the plans on the right basis. And I suppose when we talk about the housing market and the impact of COVID-19, the question that we're facing at the moment is really, is this going to turn the housing market upside down? Now, we are fortunate and quite lucky in that we have more readily available data now than perhaps any other time since I've been operating as a researcher in the past 14 years. And the chart which you have in front of you looks at data which is provided by a data provider known as 20CI. And they essentially record every property which is marked as sold subject to contract on a website in any particular week or any particular month. And we can also see in the lines, as opposed to the bars, what has happened to new instruction levels. And you can see here the very dramatic impact which the lockdown has had on the UK housing market, with the number of properties being marked sold subject to contract falling by 83% compared to the same month last year in April. But some encouraging news coming out then in May 2020, where they got up to 41%. What I suppose is more interesting is what's happened on a week-by-week basis, and we can take that data and update it to the week ending the 7th of June. And there you can see week on week, as the lockdown has eased, a very strong and perhaps surprisingly strong improvement in transaction levels. So a level of resolve in the housing market, which I think, given the economic context, none of us anticipated. What I suppose is also interesting is that generally we've seen the number of properties which are marked as sold subject to contract and therefore coming off the market has been higher than the level of new instructions over each of the final 2 weeks of that slide. And that would suggest that there is a clear place in what could be a relatively poorly supplied market for new build. The bigger question, though, is whether or not this trend can continue. Is this simply a build-up of pent-up demand, or is it something which can be sustained? And I suppose the big question there is, how does it sit against consumer confidence? So if we have a look at consumer confidence back in May last year, you can see generally that was just marginally positive, albeit that at this time in May last year, people had concerns about their personal finances, and they were pretty broadly neutral about what they felt about it being a good time for the purchase of a major item such as a car or indeed a home. It is the weakness of that consumer confidence index that we see at the current time, particularly that major purchase index at a reading of minus 41% in May 2020, which suggests to us that the strength and the resolve that we see in transaction numbers, as and when we start to see pent-up demand dissipate, that we may well not see the level of transaction activity that we've seen recently continue through to the end of the year. But it's not all doom and gloom, because I think there are a number of features why what we're witnessing now is different to previous housing market downturns. And here I'd like to thank Stuart Paisley for providing the image of the point in time when he started his working career. It is, of course, the Great Depression of 1929. But why is the current situation different to that? And I think there's probably to that, and actually the downturns that we saw in the early 1990s and post-credit crunch. And there's a couple of key reasons. The first one is that house price growth in the run-up to the crisis has been modest. Whether you look over the period in the year before COVID-19, the 5 years before that, or 10 years, much less significant levels of price growth. And indeed, interest rates have been cut very rapidly, meaning for those with a stable income, affordability is unlikely to be an issue in the housing market at the current time. As, if not more important to that, is the prospect that the economic downturn will take a distinct V-shaped, albeit that it's deep and possibly lopsided, but that gives an opportunity for consumer confidence to improve. Furthermore, the government has taken relatively swift action to support jobs and earnings through its extended furlough scheme, and lenders themselves have taken a fairly benevolent approach to mortgage lending with the extension of mortgage holidays. So all of that takes some pressure off the housing market. What does that mean? Well, again, I'm grateful for Stuart for providing two of his favourite images. I asked him to provide images of a V shape. These were the two that he came up with. What does that V shape mean for the UK housing market? Well, I think there is still the distinct possibility of prices softening. They're not like anything to the same degree that we've seen in previous downturns, down by in the order of 5 to 10%. Because of this incredibly low interest rate environment, and in the context of previous downturns, a relatively swift recovery in employment, that certainly leaves capacity for medium-term house price growth. We know, as we've seen previously, there is likely to be short-term disruption to transaction levels, and the sustained recovery of those is going to be heavily dependent on buyer and seller confidence in their household finances and indeed in their job security. What does that mean in practical terms? Well, we've said that we think prices in the short term could fall by in the order of 5 to 10%. We think sustained recovery in house prices is likely really to be delayed until 2022, but there is the prospect of some very strong house price growth as the economy recovers in that year and interest rates stay low. And that allows us to stand by our house price forecasts of around 15% across the UK as a whole over the period of the next 5 years. One of the reasons why we don't think the recovery will come back in 2021 is the possibility of an overhang of Brexit negotiations and extension of the transition period. In terms of transactions, and I suppose this is all important to the development industry, there is no doubt that we will see a significant fall in transaction levels in 2020 compared to those in 2019, when they were around what appears to be the new normal of 1.2 million a year. And that 1.2 million a year, let's not forget, was driven by pretty strong first-time buyer activity, subject to the fact that people were trading up less often, something that perhaps may change as a result of COVID. And we saw certain parts of the market under significant pressure, buy-to-let. But still, in 2019, supporting those transaction levels about 1.2. In terms of what we see in 2020, we estimated at the beginning of the lockdown that transaction levels might this year end up between 566,000 and 745,000. The simple reopening of the housing market suggests that this year it is likely that they will be at the top end of that range. In contrast, if you look to next year, I suspect they're likely to be towards the bottom of the range that we've suggested, if not perhaps a little lower than that, because over the period of the lockdown, the precise impact and the depth of the impact which will have on the UK economy and jobs has become more evident, and it is clear that that is going to take longer to recover than perhaps all of us initially suggested. And then much in line with a bounce in house prices in 2022, the prospect that house prices in that year are somewhat higher. In terms of how that plays out regionally, one of the things that we know historically is that we have been at a changed point in the housing market cycle, one where generally London and the South East look relatively highly priced relative to the UK and therefore cannot sustain the same level of house price growth. Whereas if you look to the Midlands and the north of the country, much more capacity for house price growth, largely because of what's happened in the period since between 2005, 2006 and 2016. I think the impact of COVID-19 on the economy and particularly unemployment could interrupt that particular cycle. So if we look at the downside forecasts for unemployment that come out of Oxford Economics, you can see a stronger employment market between 2019 and 2022 in London and London's hinterland. So the potential for the beginning of the recovery to be stronger in London and the South East before we see a resumption of the normal cycle, where over the next 5 years we still have more capacity and stronger house price growth across the period as a whole in the markets of the Midlands, the North, Scotland, and indeed Wales. What do we know about then about the house building industry? Where has that taken us? Well, Clearly, one of the major impacts lockdown has been on the ability of people to get on site and their levels of production. Some good news, clearly, in that respect. According to Glenigan, at the end of May, 84% of sites were open, a significant increase from the 58% which we saw in early April. And Build UK telling us that productivity on those sites having gone from 29% to a much more healthy figure of 67%, but still an anticipation that over the remainder of this year, there will be physical constraints on production capacity, which reduces the risk of a significant overhang of unsold stock if the level of transactions which we've seen over recent weeks fails to be sustained over the remainder of the year. In terms of stuff coming down through the pipeline, we can have a look at what's happened to planning consents. And those planning consents from people taking a medium-term view beyond COVID-19 are relatively robust. So relatively little impact on the number of sites above 10 units which are obtaining planning consent. Those numbers remaining relatively robust. So what is it from a housing delivery perspective? Here with the image I've taken, we've moved on. Again, this comes from Stuart's private collections of photos. This is a little later in his career at the height of the Newtown movement. So we've talked already about physical constraints on delivery and the prospect that house builders are likely to be building into relatively uncertain market conditions over the course of this year and next. What is that likely to mean? Well, it is, of course, going to place greater reliance on Help to Buy, and particularly for the smaller and medium-sized house builders, intervention from Homes England, whether that's funding infrastructure, whether that's providing funding to sustain levels of production. Those two areas are going to be really critically important. Of course, in the event that we see transaction levels at a lower level and production continue, then in order to maintain rates of sale, we may well see some recourse of bulk sales into what is a particularly strong and growing build-to-rent market. From a policy perspective, I suppose what we've learned from COVID-19 is to value the NHS much more greatly, and indeed other key workers, than perhaps we have done in the past. And I suspect that that will be reflected in planning policy. It will be interesting to see whether First Homes, as an example, becomes more closely targeted to key worker accommodation. What that will do, I think, is present much more opportunities for housing associations and indeed local authorities. But of course, for those organisations, there are some competing financial pressures coming not just from fire safety, but also from their obligations around zero carbon. And I think it's against that context that you've seen some funds and investors see the social benefits they have from being involved in the development of affordable housing. And it's for that reason that I think we could see the continued rise of the for-profit registered provider or housing association sector backed up by private equity. So very much within the ESG agenda, the S playing out, I think, in housing policy as we go forward. One of the things which we have done over the course of the lockdown is survey our registered buyers to see how COVID-19 has changed their attitudes. And this is taken from a survey which we conducted at the back end of April. And one of the things that it tells us by looking at the bars and the columns on the left-hand side is that people are thinking much more closely about the space that they occupy. So the experience of the lockdown making those under 50 consider whether or not they have stretched themselves as far as they can within their existing home and actually have reached a point where upsizing is a necessity given the experience which they've had over the period of the last 2 to 3 months. What I suppose we found interesting was around that sort of right-sizing agenda. So we also have seen an increased propensity for people to consider downsizing. Those over the age of 50. And I think that's one thing that will continue to support the retirement housing market as we go forward, a market which we think is fundamentally undersupplied and where there remains significant opportunity for innovation. In terms of things that perhaps might be more obvious, clearly the experience of working from home has meant that people using Zoom, using Teams, using all of the new tools which they have at their disposal, believe that working from home more regularly is a pretty significant likelihood as we go forward. What's interesting then, I suppose, is whilst they want to work from home and they need the space to be able to do that, they are perhaps not quite as keen to accept a longer commute. And that suggests that you're more likely to get a concentration of demand in some of the suburban areas and rural areas which remain in decent striking distance of the major employment markets, whether that's London, Birmingham, Manchester, Edinburgh, Glasgow, Cardiff, or indeed wherever. So I suspect, that will be the accessible countryside and suburban areas with more space that will benefit from that particular change in outlook. The other thing that we looked at then was how it impacted on property attributes, and no surprise there that people more carefully valuing their accessibility to Wi-Fi, the ability to have more garden and outside space, which may change the way we plan our spaces within new developments, and taking renewed importance within placemaking. Having a separate space to work from home may well change the layout of the stock which is being delivered. What also, I suppose, is quite interesting is that owners are valuing a little bit more the size and the number of rooms over the character or architectural style of the property that they're considering. Now, slap in the bang in the middle of all of those, of course, is this issue around environmental credentials, or what we can see here in terms of environmental credentials, which by the magical press of a button, I've changed to green. And there you can see of the people who we surveyed, some 30% felt that the environmental credentials of what they were buying had become more important. And this, I suppose, is that awakening of their environmental conscience, which has been accelerated by COVID-19, which could have perhaps the most significant long-term impact on the development industry and the housing market more generally. And what we also know is that within the second-hand market, those more environmentally friendly, energy efficient buildings with better environmental credentials do indeed carry something of a premium. So this involved us looking at all of the data that was available from EPC certificates matched against land registry sales and calculating the average pounds per square foot of those sales. And you can see there for stock which is A or B rated, a premium of 10 to 11%, whereas the least energy efficient in F or G, you can see there that prices relative to the average, the band D property, somewhat lower. Now, of course, for the new build industry, pretty much all stock has to be and is within that A and B category. But the premium which this shows is an important part, I suppose, of underpinning the new build premium that we know exists within nations. But I wanted really then to finish, if I could, by looking at what other impacts that growing environmental awareness may have for the housing market and the industry more generally. So this is my blue sky thinking. In reality, I couldn't find a slide which I liked a great deal to represent blue sky thinking. So I've gone the other way and I've gone to Blue Sky Mining, an exceptional new wave rock album from 1990 from the Australian band Midnight Oil. If anyone can find the tenuous link from these images to the environmental concerns and the impact of the environment, then Stuart tells me that he will gladly give them half an hour's free access to his extensive wine collection. So answers on a postcard, please. So what impact do we think this environmental awakening could have on the market more generally? Well, we already have minimum EPC standards for lettings, and it is very easy to see a situation where those are tightened and widened in terms of ability to let, sell, or do anything else with residential property. That has the potential to create and crystallize latent liabilities in existing housing stock, as people essentially are required to look at the energy performance and environmental credentials of their home and do something about it. That we think has the potential both to affect accessibility to mortgage debt and potentially even its cost, as we see the ESG agenda of the lenders start to differentiate between those properties with good, medium, moderate, or poor eco credentials. From a development perspective, as we're already seeing, we see it extensively through the planning system, but I think that the traffic is only likely to be one way in this respect. So that increasingly we will see ESG will affect what we build, how that is serviced, whether that be through the energy which is put into the house, whether it be how it's connected into the transport infrastructure. All of those things I think will play out with more importance as we go forward. Already it impacts where we build it, but perhaps more so with a much greater emphasis on living and working within a much tighter radius, and also how we build it. I suspect, given the ability to control the quality of output through MMC, it may well act as a further catalyst for the expansion of MMC as a means of delivering housing, not least given the need to sustain production to meet house building targets. So from there, I suppose, what does it mean for the industry? Well, I suspect the next logical step will be that house builders will continue to develop and build on their eco-credentials, because all of that would suggest that those eco-credentials are the next natural extension to placemaking and the building of a community, which, of course, is the game that we are all in. And that's me done. I hope you found that useful. I'm going to hand you back now. Thank you.
So thanks, Lucian. What a great presentation, great slides, very, very engaging. You mentioned there of eco-credentials. That's something I will come back to at the end and ask all the panelists about the green recovery. I think we've got time for one question, Lucian. I'm sure the audience will be interested in this one, which is, are you surprised by how well the market is holding up?
Yeah, I mean, I am quite surprised, actually, particularly in terms of those transaction levels. We knew that there was going to be some pent-up demand, but the extent of that pent-up demand has been surprising. Of course, what that isn't is a guarantee as to how long it will last going forward. And I think it's for that reason that Help to Buy is going to be absolutely critical in terms of underpinning the market and sustaining production if the government's going to meet its house building targets.
Okay. Thanks, Lucian. So we'll look forward to hearing from you on the panel that I mentioned a few moments ago. So thanks again for your presentation. Great to see an obscure reference to Midnight Oil, and but much more natural references to Stuart Baisley, which always go down well at these events. So thanks again, Lucian.